Let's bring in Randy Kroszner, former Federal Reserve Board governor, University of Chicago Booth School of Business professor. Randy, it's good to have you here. And it was an interesting press conference, obviously, and I think maybe has to be viewed through the filter of, OK, we have no dot plot, so that's not going to speak for the committee's outlook. Fed chair often wants to preserve some optionality, make sure you're not locked into some kind of outcome in 6 weeks. And then there is some division on the committee. So how does it net out in terms of the path of rates from here?
Well, that's exactly right. I mean, as Jay Powell said, he said, we're driving through a fog right now because they don't have all the data. They like to have data. They're kind of data-focused people at the Fed. And not knowing where the labor market is a problem because that's half of the dual mandate. And so I can understand why he would strike a note of caution, because we just don't know exactly where we are. And so now it's much more up to interpretation rather than data. Well, is the labor market weakening? Is it not weakening? Is how much pressure will be coming from tariffs? That becomes much more sort of an open debate rather than one that data can resolve. And so that's why I think he struck a note of caution for December.
It seems there's been a view that maybe has gotten its way into the market stance on all this, which is in the absence of real-time government data on jobs, on updates on GDP and consumer and all the rest of it, that maybe it kind of tipped the scale slightly in the direction of insurance cuts, or maybe, acknowledging that the labor market weakness probably was prolonged rather than just a blip, and therefore maybe we get more diversity. He doesn't really seem to want investors to have comfort in that idea.
And I think that's reasonable, because when you're not, it was clear what the trend was. The data and the data revisions from the last official numbers we have on the labor market suggest a pretty substantial decline, and usually that's when that starts getting going, it continues. It's rare that it's just because it wasn't just a 1 month blip, it was 3 or 4 months of weakening. But I can also see why you would say, well, hold on a second, folks. We really don't know. Hopefully we'll get some data by the time our next meeting comes around in 6 weeks. We don't know that. And so I can understand why you prefer to be focused on data rather than focused on vibe. And they're going to have to make decisions based on vibes rather than on data. That's not a good place to be.
Yeah, the other piece of it, though, perhaps, Randy, is the long-term Treasury yields are not acting in a way as if they are really on inflation alert, right? So we've cut rates, and the long end didn't go crazy, and therefore It seems if the market is willing to tolerate this level of inflation. I wonder if that feeds into the Fed's view.
Yeah, I think from my perspective, I think the markets have spoken very clearly. They have the same view that I've had for a long time, that the tariffs will have an impact, but they're probably going to be temporary, and they'll be relatively muted. And that's what we've seen so far. Inflation certainly is above the Fed's goal, and it's instead of coming down painfully gradually towards it, it's sort of flatlined a bit because of the tariffs. But my guess is that after the tariffs work their way through the system, we'll be on that path down. And I think the markets feel very comfortable with that. They clearly we haven't seen an uptick in inflation expectations. We haven't seen an uptick in the long-term rate. So they seem to be comfortable with where it is. But I can understand the caution that Jay and some of his colleagues have of saying, well, we don't want to bake it into the cake, because what if the labor market numbers come out a bit stronger than we had expected?